Welcome to the Conquer the Mummy channel, where we use nonlinear analysis to point to the future trends of the markets. Currently, we're looking at the S&P 500. My name is Grady Garrett. I'm the Chief Strategist of www.conquerthemummy.com, an independent nonlinear research provider. I have over 34 years of model building experience in the financial instrument trading arena. I have worked for firms that were pioneers in applying artificial intelligence and mechanical optimization systems to the markets. The purpose of this channel is as follows: to move beyond technical analysis for market prediction. Before computers, technical analysis was mainly trend lines, support/resistance areas, and the occasional retracement calculation. After computers, moving averages, RSIs, and MACDs became the norm. The automated calculations became standard fare for charting on various websites. If you called your 80-year-old grandmother and asked her if the S&P 500 was above the 22-day moving average, she would probably tell you within a minute or so. Um, but information that is fully disseminated loses its predictive power. If the Imperial Japanese Navy knows the U.S. carriers are lying in wait, they have a much better day at the Battle of Midway. Nonlinear analysis involves calculations that, while not crazy complicated, are challenging to apply to real-world situations. Like market analysis, the traveler comes across a skull atop a spike with a dark butterfly resting on it. Several dire warnings are posted. Number one is long-term predictability is impossible due to measurement limitations. The second, the search space for the solution becomes enormous. But the skull is meant to scare away, not to educate. It does not offer that even chaotic systems have internal order. Strange attractors, they are called. Order under disorder. A faithful might even posit the fingerprint of God. Is there a short explanation for this? Linear trends you can usually see with the eye, nonlinear trends not so much. This channel is going to analyze the popular S&P 500 index using nonlinear techniques to determine trend expectations, bullish, bearish, or flat, even as a shorter over a shorter time frame than using explanatory aspect of technical analysis to flesh out what is going on. Do not consider comments on this channel investment advice. The comments are general and do not take into account individual special factors such as risk tolerance and suitability. We are simply discussing general trends. All right, let's take a look at where we are currently versus the market versus our signals. So over and generally our focus charts are about 2 months, and so we expect to get at least a couple of signal changes within a month or within a couple of month period. So I guess the first question is, are the models in sync? So if you take a look at this, I've got 3 signals. Let me first just mention something briefly about TTP, or theoretical trade price. To help quantify the measurement of a signal, and since signals are usually posted later in the evenings after the markets are closed, I measure the signal, the closing price on the day after the signal. I treat that as the entry point and also the exit point. So the trading day after the signal is actually the transaction day in my methodology. So we can see on 331, even though the signal was on that day, the actual trade would have been on April 1st. So it kind of helped that day because the markets went down a little bit. And when you want to go down on the day that you assume a position. And then on the flat signal 420, when the trend went flat, we had a similar down day, but in this case it hurt us because we are selling lower when we want to sell higher. But we did not stay in that flat trend very long. The signals reversed, and on 427 we were back with a bullish signal, and that TTP was the next day, and that was on the so the signal was on the 27th. The TTP would have been on the 28th, and just a little bit better. and then we're still on that signal. We're still expecting, with our nonlinear analysis, we're expecting higher prices. All right, so let's discuss the current signal. As I just mentioned, we are expecting higher prices. That we expect the trend to be up. It's actually a little more bullish now than when the signal was generated. At that time, the estimated price and the future price was 3,100. The new estimated price is off the charts. It's 37.75. For the previous 3,100 prediction, we got fairly close to it. Prices got close to 3,000. In light of this incredible volatility we're having, that's fairly close. But this new projection of 37.75 is way up there. So I'm not necessarily saying it's going to hit that, just like it didn't hit the previous one, but I am saying it's a relative indication that we expect to break out from this pause in the trading range. So does technical analysis kind of support this projection that we're going to have a breakout to the upside? Well, let's take a look at this on this chart I have. Let's see, so basically, if you choose basically any trend line on this chart, you can see it's whatever it is. Oops, that's not quite what I wanted to choose. Just one second. So in general, you see prices moving up. So that kind of supports that we are in an uptrend. Now you could also say that we're in a. Go ahead and just change that color to black. You can try to make a case anyway that we're in kind of a channel. But if you do that, you're starting to see us, bump up against the top of the channel. And so it does seem like, I also have a 22-day moving average on this. The reason I have a 22-day moving average is simply that there's 22 trading days a month, so it's kind of like saying the monthly price is moving up. So we've got that going for us, a trend going for us. Now you can try to argue we're in a channel. However, you can see these prices are starting to bump up and even violate the channel a little bit on the upside. Is there a technical analysis interpretation that might say this is a reversal to the downside? The only one you can possibly think of would be something along the head and shoulders line, where you would have a head and shoulders. Let's see, all the dates on that would be maybe April 17th, and the head would be maybe the 29th, and the other shoulder would be May 11th. You could do something like that if you wanted to. However, if you go into that interpretation, the neckline would be between this point, if you can see that. See, I'm going to go ahead and just make this worse so we can see a little bit better. So you would choose a neckline somewhere using these two, or I'm sorry, these three. And if you chose that as the neckline, you're going to see that we're not really violating that now. In fact, it's going the other way. So I would say, at least over this time frame, technical analysis is pretty positive. So it is supporting kind of our nonlinear analysis on this. So what about the fundamental political backdrop? One thing that I've noticed is happening is when people use fundamental analysis, especially in this time period, they're doing, basically that is you're doing comparisons between the time period before COVID and the shutdown, and the time period after the shutdown. And of course, these figures it's almost like you're not comparing apples to apples anymore. And so these figures are very, very negative. So that's the downside of that. In fact, if you look at this 2-day drop in here, I'll make this red here. During this time period, the Fed chairman, Powell, came out, and his report was fairly, I would say short term it's fairly grim. Now long term, he's positive. We'll do better in the long term, but I was very measured over the short term. And then the markets kind of took that. They kind of tried to rally up that day back to the opening. However, CNBC then sent out one of the hot-headed hedge fund managers that they follow, and that person made a big point of how overvalued in fundamental terms, earnings ratio terms, that the market is. And so when that was done, the market was just had to sink a little bit and sag. It just wasn't able to absorb that information right away in a positive way. However, you can see that after those negative talks, at least semi-negative talks, but I would say they're negative, came out and the market was marked down. As time went forward, then buyers, there simply weren't enough sellers to keep that moving down, and the buyers came in and start to drift up. So I think you need to, as a trader, you need to be aware of fundamental analysis, especially in this time period. We all know about COVID. We all know about the shutdown. So all that's in the market. It's not predictive. It's the past basically. So looking forward, you have to use other activities like technical analysis or nonlinear analysis to get a better handle as to what the future holds. In fact, right now, if a person, whether it's a government official or a hedge fund manager, comes on and starts talking about fundamental analysis, you're probably better off just muting a screen for a while until he passes on, than taking the channel off mute. All right, that's all I have today. I just want to encourage you, if you like this material that you're hearing, please subscribe to the channel, and please mark this video as liked. And I want to leave you with a quote from Chester Nimitz. This was just before the Battle of Midway. It says that everyone has now agreed on where his wedding is going to be held. We just need to know how many guests are coming and when they plan to arrive. All right. Thank you for calling, or thank you for watching the Conquer the Mummy channel. Have a great day. Bye.